In today's show, I will break down each term that you need to know to analyze deals with confidence. I am Sarah Weaver. I coach real estate agents and investors on how to grow their real estate portfolio. If you're a real estate agent looking to work with investor clients, this is the show for you. Welcome to the Investor Agent Show. Now go ahead and subscribe to this channel so that you don't miss a thing. Be sure to follow me on Instagram at Sarah D. Weaver to see how I grow my portfolio while traveling the world. In today's show, I will demonstrate how just about anyone can analyze a deal in any market with these four terms: net operating income, cash flow, cash on cash return, and cap rate. The equation for cash flow is net operating income minus debt payments equals cash flow. This is how you calculate net operating income. You take gross operating income minus gross operating expenses. That equals net operating income, or NOI. How do you calculate gross operating income? You take rent minus any vacancies plus any other income. That equals gross operating income. Now, how do you calculate gross operating expenses? Gross operating expenses include property taxes, insurance, maintenance and repairs, utilities, and property management fees. So why does NOI matter? Commercial lenders will value the property based on the net operating income. The higher the net operating income, the higher the value of the property. That means you can control the value of the property by increasing the NOI. Commercial lenders use NOI, or net operating income, to determine the value of a property. Increase the NOI, increase the value of the property. Now that you know NOI, we can talk about my favorite term, cash flow, because it's all about the cash flow, unless you invest for appreciation, and then good for you. Cash flow is calculated by taking the net operating income, which you now know how to calculate, minus debt payments. That equals cash flow. Next, we have cash on cash return. Cash on cash return is calculated by taking your annual cash flow divided by total initial investment. Your total initial investment includes things like your down payment, closing costs, and any upfront rehab. And if you're furnishing the property, maybe you include the furniture in that calculation as well. Let me give you an example. My initial investment is $100,000. If my annual cash flow is $10,000 for the year, my annual cash flow is $10,000, I'm going to take $10,000 divided by $100,000. That equals 10%, or a 10% cash on cash return. I recommend thinking of this like, how much money do I have to put in to get how much money out every year? That is your cash on cash return. Next is cap rate. You calculate this by taking your NOI divided by purchase price. An easy math example would be if your NOI is $100,000 a year and it was $1 million purchase price, then congratulations, that's a 10 cap, or a 10% cap rate. So what do you do now? I recommend you analyze some deals to practice your new tricks. Here are some of the key pieces of information that you will need to quickly and confidently analyze a deal. First, you're going to need to know the purchase price. Oftentimes, this isn't the listing price. It may cost you more or less to win the deal. That is your purchase price. Real estate agents, you want to be sure to give your clients a realistic number of what it's going to take to win the deal. Next, you need to determine upfront renovations. For the sake of this video, I'm going to assume you're Bob the Builder himself. You can automatically determine the price per square foot on LVP, the replacement cost of a rental grade kitchen, so on and so forth. You could walk a property, look at photos, and automatically know how much it would cost to make this property rent ready. Next, you want to know current rents. You can ask the seller, the landlord, or the property manager, or maybe the seller's agent. How much can you rent this for before or after the rehab that you recommend? You need to determine the vacancy rate. I recommend between 5 and 8% depending on the property, the market, and the investment strategy that you're choosing. You also need to know property taxes and estimated insurance. Be sure to check that this property is not in a flood zone. Find out if there are landlord-paid utilities. Often on a single-family home with a long-term buy and hold strategy, the tenants are going to pay all of the utilities, but maybe you will take care of lawn care. With a duplex, triplex, or fourplex, it's common to see a landlord pay for things like water and trash, snow removal, and lawn care. Be sure to calculate those expenses in your calculations. Next, include property management fees. Often I set aside between 7 and 10% every month, depending on the property manager. I set aside 5% for maintenance and repairs, another 5% for capital expenditures, also known as CapEx. Lastly, you want to know the financing terms. What are the closing costs? Are you paying points up front? What's the interest rate and amortization? All of these get factored in when you're analyzing a deal. Thank you so much for joining the Investor Agent Show. Next week, I will be showing you how to find off-market deals.